Right, my name is Daryl Martin, and thank you so much for joining me for this presentation here at ApexInvesting.com. And today we're going to be talking about the spread and touch bracket scanner that we've made for Nadex, which is available to you for free over at ApexInvesting.com. And it makes it so much easier to trade. Now, I have other videos already on the site where you can go in and learn how to access it, get access for free, and learn how to do different order types. Also learn how to use the binaries and the price simulator on the binaries. But today we're going to talk about the spreads and touch brackets on this quick video, okay? So one of the things I want you to see is that we have, spreads and touch brackets in the same area. So you don't have to, like over on Nadex, you have to go in and look at the spreads, touch brackets. You also have to look at different expirations, 3 o'clock, 4 o'clock, 4:15, how many ever there may be, right? And you can only look at one market and one expiration at a time on Nadex. Over here, we can go in and we can look at the touch brackets on multiple markets at a time. And I can even get rid of all the spreads just by going in here as it's loading up every single market I made. It's selected 4, so it's got to load up a lot of contracts. Once it does, it is lightning fast. And I can go, you know what, I just want to see touch brackets. I don't want to see all the spreads. And so all I got to do is click the touch brackets. And now you'll notice I have all the touch brackets quoting for me on the exact same page. Super easy. I could even add in, say, euro dollar if I wanted to. And it'll go through, it'll filter out all the spreads, and then just show me the touch brackets. So it makes it super easy to see the touch brackets, or if you don't want to see touch brackets, you could say, I want to see the call spreads. And then it will just show you the call spreads that are available. Or if you want to see all of them, you just click both. So that's one of the first things, just to make sure you have that down. The next thing, let's go ahead and let's just, remove a couple pieces real quick. We'll look at, say, the S&P. And one of my favorite things about the scanner is it makes it really easy on the spreads and touch brackets to see your risk reward. Not only can you see your risk reward on the right instantly without having to open a ticket or do the math in your head and calculate it, so you can sort of know, what has the risk reward you're looking for, but you also can see how far away the bidder offer price is from the underlying market or the indicative index. So in this case, it's saying, this contract is pretty much quoting 312.9 right to 312.8, 8. So it's quoting basically no ticks in proximity away. It's quoting right at the same price as the underlying market. This contract is quoting about a tick higher. And where that tick, by the way, is based on the underlying market. So the S&P 500 E-mini futures actually tick in 0.25. So right now it's saying it's about 2 ticks away. It's saying this one is 11 ticks, again, 11 underlying ticks away. So what does all that mean? Like 11 ticks, 1 tick, 2 tick? Again, that's the difference between where the indicative is and where you're buying, or where the indicative is and where you're selling. Okay? And to visually help you see that, you can actually click over here, this little white space on the side here, and it'll pop up a risk reward graph. And you can see exactly what the risk and reward is, and you can see the floor and the ceiling of the spread. Okay, so we have the floor and the ceiling of the spread. We got the underlying market. Okay, so this is the price as it starts down here, it goes up, and then the profit and loss that it would make depending upon where the indicative expires at. Okay, so you can see right here, like the P&L is at 0. What does that mean? That means if the market, which is this black line, that's the indicative index, 3012.7 there. If it doesn't at least move to that price level by expiration, then you'll have max loss. Now, max loss in this case, of course, is only $4, but the chance of making, getting up there, it has to move pretty far. It has to move, almost 3 points or 11 ticks to be able to even get to that break-even point. Whereas we go look at, say, this contract, and it just has to move 1 or 2 ticks to get to break even. Now the risk is higher, but your risk of the market having to move is higher here. And of course, the thing to remind you of, something I teach over on ApexInvesting.com, we have an integrations course where I teach you all about spreads, touch brackets, futures, forks, and even how to combine them together. And I teach you what you need to know how to pick the right spread. And some people go, man, this feels so complex. Well, really, this is actually easy. You just have to know what you're looking for. And if you don't know what you're looking for, it's even harder using the Nadex platform. So this helps you find what you're looking for really fast. And you may want to go in and go, you know what, I want a touch bracket or a spread or whatever. I can click on that touch bracket. I can see, hey, it's trading right at the market. And then I can say, you know what, I want to hedge it off here with a lower risk contract. And so I'm going to want to find one with as low risk as possible, as close as possible, because this has $106 of risk. But you know what? If I go in and grab, say, this contract short, that's not going to do me much good, right? It has to move 33 ticks for it to even get down there. It's not going to really make any profit for me. But if I find one with maybe a little lower risk, like this one, well, right out of the gate, I'm going to get a hedge. Okay? As it goes down, this contract's going to be making money while this contract loses money. And so it's going to help cover and really lower my risk. Now my risk is no longer going to be a full $104 because this can make 82 of that 104 for me on the way down. And then all it needs to go to get to break even now is where these two lines intersect. Cross right up here, and then we're making some money. So there's a lot of cool ways you can put this together. Again, I teach you a lot more about this in the integrations course. But you can go in and you can do straddles. You can do, like here's an example of like a straddle. Let me uncheck that. That's a pretty wide straddle. But let's see, we can match up some floors and ceilings here. 3015, do that one right there. And now we got a straddle. Like if the market goes up far enough to cover the risk on this side, or if it goes down far enough, remember down with the left and right here on the price, to cover the small risk on that side, we can make money in either direction. And I can actually see how far it has to move in order to do that. So again, the graphs are great. Again, that's P&L, and then over here, and you can mix and match all sorts of combinations up. You can end up putting together straddles and strangles over here. Iron condors, different iron albatrosses. So there's different positions that you can put together and analyze them really, really, really easy. All right, so now you know how to access that. You can see what is a call spread, what is that touch bracket with that C and T on it. You can see you got your buy side, your sell side there, the price. You can see the proximity, how close is it to the market. You can also see your risk reward instantly, and you can view it on a graph. So you can look at multiple markets, and of course you can look at, you can narrow it down. We'll talk a little bit more how to narrow it down here in a second. The last extra piece that's on the graph here, and this is a little bit more advanced, but it's premium. And premium is, you have two parts of a spread price, okay, an option spread here. And you have what's called extrinsic and intrinsic value. So those are really fancy words, okay? One means time value, one means like real value. So what the premium will tell you is if the market doesn't move at all, you'll make that much. Okay, so I'm actually able to buy right here on this contract a little bit lower. The market's at 313.5. I'm able to buy it right here. And look at this. See, like if I can buy right here where this zero line is, that's where I'm buying. And the market's up here. So I could buy like at literally 3012.9, and the market just stayed flat at 3013.4. I'd basically make, a full, point or $5 here. Okay? So I'd make that $5 or $4 in premium. If the market didn't even move, it could actually move against me that far. And since I'm, buying below the market, if it moved against me, I'd still be break even right there. Okay? Because I'm buying right here. Now, if it moves in my favor, then not only could I make the premium, but I could make more than that. Now, on the inverse side, maybe you have negative premium. And negative and positive premium isn't such a big deal. Don't get overwhelmed by it. But, it can get large, especially if we look at a market like NASDAQ. And you can all of a sudden, you can see some pretty big premiums. Like paying 34 or, you lose $40 if it doesn't move. On this one, you can make $36 if the market doesn't move because you're buying here, and if it just stays flat, you make $36. So it's pretty cool. It helps you see how far below or above the market you're actually buying, which is what the proximity is, but also the premium helps you see how much you would make or lose if the market stayed flat and didn't move at all. Okay? So, again, I go into that a lot more depth inside the integrations course, but I want to let you know what that is. It's the premium, it's the extrinsic or time value. Again, if the market didn't move and just time passed and it expired, you'd have some cash in your pocket. Okay? Now, let's go down and let's talk about the filters. So let's say I didn't want to see contracts that expired in, less than, I want at least say 15 minutes. All I gotta do is say 15 minutes and boom, it gets rid of those contracts. Now, let's say I wanted ones that had at least, an hour. Well, in this case, or no more than an hour, nothing applies. But if I said 2 hours, it showed things between 15 minutes and 2 hours. Okay? Now, when you start playing with these filters, sometimes you can click things and not know what you clicked and get a little confusing. So one thing is going to be your friend, okay? And that's going to be this little button right here called default. If you don't know why you can't see something, like maybe I chose that and nothing is showing up, easiest solution, click default. It'll reset everything. You can just go back and reselect your market, and then from there, figure out what you want to trade. Okay? So again, default is your friend if you're confused as to why nothing is showing up. By the way, don't worry about this little group thing up here. You won't see that. That's for an administrative function. Okay? So let's see here. Let's go down. Let's check out. Okay, here's another feature. Now we can look at a buy side only, right? And I can say only ones that have at least 5 minutes to expiration. I could look at sell side only. All right, I could look at weekly. Well, what's that going to show me? It's going to show me just the touch brackets. So it's ones that literally have a 1 week expiration. I could say show me the intraday contracts. And I could say show me the daily contracts. Or any. Okay, so those are options that you can use. It's great, especially when you have a ton of spreads, to help you narrow it down. And again, this is all about sort of knowing what you want. Now, let's talk about a little feature that can confuse some people. This in the spread, deep in the spread, near the spread, out of the spread, what that means. So, out of the spread means that the indicative itself on a buy side, okay, is below the spread. Now, if we flip that around on a sell side, that means the indicative is above the ceiling of the spread. So see, it's not inside the spread, it's out of the spread. Now, that can be flipped around, okay? Like we could have deep in the spread. So deep in the spread means on a buy side, it's above. The indicative is above the ceiling of the spread. And notice how I make a dollar if the market doesn't move, right? So I'm buying at 3009.9, the ceiling is 3010. And the indicative is 3013.25. So I'm buying like 14 ticks out of the market here. And so if it stays flat, I make a buck. If it moves up, I make a buck. If it moves down, but not further down than 3009.9, then I make a buck. Now, buck, again, not that impressive, but we can hop over to something that has more premium in it normally, like the Nasdaq, and I can go in and find a deep in the spread contract. Like this one is 15 bucks. So it's up here, and I make 15 bucks if the market moves up, if the market stays here, or even if the indicative comes down, but not lower than where I bought it, 7943.6. So it has to drop down over 10 points for me to actually really be losing money on the spread as of expiration there. Okay? So deep in the spread, above it, okay, you'll make the money. You'll see deep in the spreads are positive premium. Okay? You'll see, out of the spread contracts are always going to be negative premium, because you're going to lose whatever risk you're putting up on that contract if the market doesn't move at all. Because that's all time value. Right? Because it's outside of the contract. If it just expires right there at 79.54 and the floor of the contract is 79.55, then the risk you're putting up, that's just time value. So as the time goes away, the value goes away. Now, it doesn't go away just because you get in, right? And it doesn't go away just because you get out. It goes away because time passes. And I go into a little bit more in-depth on that again in the integrations course, but just to give you a basic understanding, okay? And again, this contract now it's moved from out of the spread to in the spread. Look, the indicative is now inside the floor and the ceiling. It's moved into the spread. We still have some premium. We have $25. A premium we're paying because we're buying the contract, in this case, higher. Buying at 79.58 and the market's at 79.55. So you really don't want to buy it higher than where the market is normally. You know, that wouldn't be your, unless that's very much on purpose, may not be your goal there. But just understand, like, that premium is in there, and the market's going to have to move up to this break-even point for you to really be. You may make some along the way, will move slower. Once it gets to this point, it'll start moving faster in your favor. But as of expiration, it has to be at least to this point or higher. So that's in the spread. Pretty simple. The market's in between the floor and the ceiling. Out of the spread, it's below it or above it. Deep in the spread, positive premium, below it or above it. And then there's one other one, which we call near the market. There's not really at the money on this, because at the money would be like right at the floor, right at the ceiling, and that's just confusing when you have two different strikes. Unlike over on a binary, we have at the money, which means when the market's at the strike, we have two strikes. So really, near the market means that the contract itself is quoting within 10 underlying ticks above or below the floor or ceiling. Or no, sorry, above or below where the market's at. So like 79.59 is within, 79.58, within 10 ticks of 79.56. Because again, NASDAQ here ticks in quarters. And there's a lot of useful information up here at the top. Not only do you have the market, you have the current symbols, you have the tick size, the indicative. Up here on this little section, see this little chain link icon? You can click that and it will give you a world of information. Not only does it give you all the expirations and how many contracts are available, it also tells you what the tick size is of, like a spread, a touch bracket. We can go over here and let's look at US 500. But, we can go over here on, say, the S&P. Not only do we have, again, the expirations, the touch brackets, all that, we also have the equivalent, the tick size. Like a Nadex spread ticks in 0.1. A Nadex touch bracket also ticks in 0.1. ES ticks in a quarter. The micro E-minis ticks in a quarter. The value of a spread is $1 a tick. The value of this touch bracket is $1 a tick. ES, the value is $12.50 a tick. Micro ES, the value is $1.25 per tick. And once you learn how to do hedging, that we teach in the integrations course, we actually tell you what the equivalents are. Like 1 ES equals 5 Nadex spreads or 5 Nadex touch brackets. 1 US spread equals 1 touch bracket. 10 micro ES equals 1 ES. 4, micros equal 1 ES, that type of stuff. Another example here on NQ, you can see that it's different. Like NQ ticks in quarters. Well, the touch brackets also tick in quarters. And it tells you the equivalencies. Like it takes 2 touch spreads to equal 1 NASDAQ future, but it takes 5 Nadex touch brackets to equal 1 NASDAQ future. So, anyways, we have all the equivalencies in there. It does a lot of math for you automatically. Makes life a little bit easier. And let's see here. So that's in the spread. We got near the market again. So just to make sure, that means the indicative is right near the market. So why would that be important? Well, maybe you want to trade the contract that are trading near the market, especially the dailies, and the wider they are, those move faster. Okay, so maybe you bought a contract and you're like, man, the market went up like 5 points and I'm only up like $2. I should be up, $50. Well, that's because you bought a way like an out of the money spread or one with large proximity. So again, very important things that we teach you inside integrations is how to know what spread to pick and how to know what spread not to pick, how to know which one to hedge with, how to know what not to hedge with. So things you need to be aware of, but this helps you quickly. I can go in and I can quickly narrow down, and see all the near the market spreads. And I can make them even tighter if I want to with other filters. So, but that right there, now I'm showing just near the markets. And I could say, give me ones that have at least 1 hour to expiration. And I only want to see buys. Since I'm using near the market, I don't have to enter proximity. But if I wanted to make it tighter, I could use this and say, only don't show anything that has anything greater than a 1 tick proximity to a -1. All right, well, there we go. Okay. So that would be an option. And I can just click reset above most of these to individually reset them, or again, default to reset everything. And then I could say, I don't want, anything more than, we'll just say -5 proximity and premium. Again, you can always just, reset that just by clicking the reset icon. And, but instead of proximity, since again, we already have that filtered, and we're not really worried about premium because we got near the market contracts. They shouldn't have a large proximity. So let's just go down and filter by risk. And again, max risk doesn't mean the risk you have to take in the sense of, that's the maximum worst case risk, but you can get out if it goes against you, right? Especially since we have, stop orders and things like that inside the scanner. But, if I'm looking at all these contracts and trying to figure out, what the best option is, there's a few different ways I could do it. I could say, I want at least a 1-to-1 risk-reward ratio. That alone got rid of all these other contracts, because all of them are expiring at the same time. They're all going to expire in 1 hour and 7 minutes. So, might as well just click 1 right there, and now I go, well, one can make 260, one can make 265, one can make 390, one can make 290. Well, think about this. If I only have to risk 40 to make 260, and only have to move like 3 ticks, man, that's not a big deal, versus 130 to risk 262, why not just choose this one? It makes basically the same amount of money as this contract does, but I can put up $100 less. And it's right near the market. Now I may go, well, yeah, but I still have, a little higher proximity, a little higher premium. Okay, well, what about this contract? This one actually can make more money than this contract can. All right, let's look at both of them. You can sort of see them both on there overlapping. One's risking 138 to make 262. One's risking 108 to make 394. And this right here is probably one of the biggest advantages. Not only can you narrow it down and find things quickly, but I can look at these two contracts. One of them, by the way, is a touch bracket. So I can get stopped out if it moves, $106 against me. This one, $136, but again, I can make more on the touch bracket. It has to move, pretty much 10 points against me for me to lose that much. So, and if I don't want to do the touch bracket, then, I got a spread right there where I can't get stopped out. I'm only risking $38. I can make pretty much the same amount of profit. And now my premium is pretty close. My proximity is within a couple ticks. Sort of helps me find what's the better trade. So how would I even know there's a touch bracket that is better? Or if I don't want to worry about the stop out, well, then how would I know the call spread that's better? Because a lot of times they may not even show up on the same section. But now with these filters, they can easily show up together. And, I can increase that reward, ratio. I can do all sorts. I can go and I can make it a 2 or, say higher and go, okay, well, now there's only 2 contracts that give me like a 3-to-1 risk to reward ratio. And I could choose out of those 2 contracts, a $38 spread, which has, another ticket proximity, a few dollars of premium, or the $103 touch bracket. So my choice. I could go, I want one with at least a $300 reward. And it narrowed down to that one contract. That's really, all there is to it. You can go in and again, you can reset the default. And, right now the markets are closing up here, but we can go over to, say, S&P. And we got all these contracts selected we were playing with. And then again, I can go, I'm looking to buy or sell. And I'm looking for a near the market contract. I'm looking for one that has at least an hour to expiration. And I want one that has at least a 2-to-1 risk reward ratio. And by the way, I'm only interested in call spreads. There you go. There's your choices. So I'll take the $36 one over the $132 one. There's only a few dollars difference in the premium, and I have a lot more potential profit, or at least compared to the risk that I'm risking. Not the same profit, but a lot less risk. So that's all there is to the spread scanner. It's lightning fast. Again, you have the stops, the trail stops. You have the instant tickets. You can go in. You can open a ticket to set a limit. You can set a stop trigger to get you out based on where the bid is or the offer is. Of course, if you're buying, selling, and then or where the indicative is. You can also do a trail stop trigger where it takes profit and it trails, tick by tick for you, 20 ticks or 30 ticks behind. I show you this in the order video how this works. We'll constantly be adding more features, but check it out and let us know if you have any questions. Inside of our trading rooms, we have multiple trading groups. We have one just for integrations members. We have one for elite members and binary members, and of course, you can also use the forum and the help desk if needed. All right. Hope y'all learned a little bit about this and see the massive value. Again, this is free over at ApexInvesting.com. Make sure you sign up for it and please tell people about it. So this is a tool I made for my own trading and I share it with y'all and just try to help as many people as possible. Y'all have a great day.